a company, they're doing currently about a little over $50 million a year and at a 20% margin. So there is about $10 million per year in profit. And this is a consult-in deal, so basically an earn-in. And the client came to me and started out as a $25K consult. And so that was basically because they were considering an offer to sell their company that they had received from somebody else, and they wanted, some help with that. And as we got to talking, it was clear that if they did the deal that was being proposed, they were going to leave quite a bit of money on the table, because I think this is a business that can sell for between 100 on the low side and 150 million on the higher side in about 3 years, and doesn't really need a whole lot of changes to do that. So, I mean, they're already netting $10 million a year. So the way that I approached it was, I said, let's do a friends and family valuation, and I will buy into the company for 10% at a 10 million valuation. So that means I've got to come up with $1 million in cash, or I can earn in. So the way that I structured it was, and I want to show you the difference, is that basically option one would be to buy stock or equity. And option two, which is the one that I am doing, is to do a profits only interest. And here is why it really helps to know how to structure deals. Because if I did the stock buy, then I would have to do one of two things. I'd either have to do 1 million cash, which I don't like doing, or I could do a 1 million earn-in, which would basically mean, oops, always nice when it erases everything, or a 1 million earn-in. And the way that that would work would be that I would have a 10% interest in the profits of the company, meaning over the period of the next 12 months, if there was no growth at all, I would have $1 million that I would have received, but instead of receiving that, I put that towards acquiring the company. So let's say that we, right off the bat, we don't like this first option because we don't want to come out of pocket $1 million cash. Now, the second option is cool because at the end of the day, we have 1 million in distributions deducted and applied to purchase price. The downside of that is that, well, the good thing is that at the end of that year, I would have had $1 million that would have been distributed to me. And I effectively, instead of distributing it to me, it goes to acquire the 10% of the company, right? Now, at that point, I would be a 10% owner of the equity of that company, but I would have to have paid taxes on those distributions at ordinary income rates, which in California approach about, it straightened the line for me, that's funny, approach about 50% between state and federal taxes, because we pay a lot of money extra to live here. So now doing that instead of as an individual in a corporation, I can get that tax rate down to 21% if I do a non-California entity that is the owner and receiving those. So right off the bat, just simple tax planning can save me 29%. But that still means that I would be out $210,000 on the million distribution. So it would cost me 1 million distribution. See if I can make the right letter there. So it would have cost me 210K to do it that way. Now, at the end of the day there, I would have paid no money out of pocket to the seller. The seller, though, would have sold the interest, and the seller would pay taxes on the $1 million that the seller received, right?